Good morning, everyone, and thank you for having me back. I saw you this time last year, I believe, in Paris, and how things have changed. So the last few sessions that I've done, I've been coming up after an economist and always feeling a bit deflated and also very worried about what I was going to present. But thank you, Chris, for that intro, the positive outlook that we have for the industry, and we are all very lucky indeed to be connected to this industry, considering what you're going to see in my presentation today. So I'm going to bring you up to speed on how it's looking 2023 so far. So I'm going up as far as April. And then we'll talk a little bit about the industry as a whole and how we seem to be combating the economic crisis and what to expect as we go into 2023 and beyond. So firstly, let's look at demand. So demand really has outperformed 2019 as we've come into 2023. It has been a long and arduous journey through 2021 and 2022, but we've got there. And there are many factors that are influencing this strengthened demand. If we look back to 2022, quarter one, there are vast differences. So firstly, there are no COVID restrictions. If you remember, just 1 year ago, we had Omicron, and there were a number of restrictions across Europe which were limiting travel. The second thing is that we have much more efficiency in the delivery of visas and the availability of visas. So travel generally has become easier. And we cannot forget how Europe has come on from the end of COVID restrictions in April 2022 and beyond due to the facility of travel throughout Europe. All of that pan-European and intra-regional travel has been facilitated by the lack of visas required for most travelers. There is, of course, increased air capacity, so we're not quite there yet. In Europe, we're about 85% of where we were in 2019, but that is really, really helping. And the seats are filled at 90%, so the load is 90% globally. That is an amazing number. And there will be some disappointed travelers this summer for sure that will not be able to get seats or will not be willing to pay the price for the seats that are available. But we are getting there. So month on month, I think in March, it was a 35% lift month on month in terms of seat capacity. There are very favorable currency conditions for a number of travelers, particularly the dollarized traveler. So although the ADRs have increased massively in many key gateway cities and resorts, for a US traveler, actually, the rates are similar to what they were in 2019 if you factor in those inflationary increases. And of course, there is a continued resilience of particularly the high-income household traveler. There still is pent-up demand, and people want to spend on services rather than goods. We spent all our money on goods during COVID. Services are still order of the day, and in particular, travel and hotels. So lots of reasons why that demand has now surged and outperformed 2019. Now, that is not reflected in occupancy levels quite yet. The reason for that, since 2019, there has been a 7% lift in supply globally. So we had a real slowdown, obviously, in 2020, but in 2021 and 2022, there were a large number of rooms delivered into the markets. And this, of course, impacts occupancy. So despite demand outperforming 2019, occupancy is just 5% off at the end of April from 2019. So not a bad result all the same. So if we look at a continent level, you can see here in the middle, Europe is running an average occupancy at the end of April of 62%, and that is just 5% behind 2019 levels. So not a bad result when you compare that to North America, just running 61%. And then, of course, the Middle East always had a higher occupancy throughout COVID and into 2022 with 68%. So all is positive with the exception, of course, of Asia-Pacific. So the Asia-Pacific region, excluding mainland China, is 10% behind. But surprisingly, mainland China is just 2% behind where it was in 2019. Since the zero COVID policy being lifted in January, there has been a surge of travel within mainland China, and then slowly the Chinese traveler is going outbound into the Asia-Pacific region and beyond. Now, really, the occupancy that we have seen grow since the second half of 2022 has really been underpinned by the occupancies in the key gateway cities. So if you remember when I spoke last year, I probably talked a lot about resorts, a lot about secondary and tertiary cities performance, but key gateway cities were still lagging behind. But now the majority of cities have a similar occupancy level to where they were at the same time in 2019, and in many cases, particularly in Northern Africa, have outperformed 2019 levels. So really the key gateway cities have been the backbone of recovery in 2022 and will further develop into 2023, as we'll see in future slides. ADR. So we're all very excited about ADR. Every time we look at it, it just continues to grow and grow. So the blue dots here are looking at a US ADR. So the European ADR is $136 at the end of April 2023, and that is a 23% lift on 2019 levels. So the exceptions, of course, are the Middle East, up 32%. Again, there was various reasons, high demand, lots of events, and that continues into 2023. And of course, we're seeing lower growth in mainland China and Asia Pacific, but all are in a very, very positive place in terms of ADR growth. And where is that coming from? I mean, the resorts, I think last year I probably talked about some resorts growing ADR by 100% and in some cases 150%, but now it is the key gateway cities. So this started, like I said, in the second half of 2022, and it looks like it is continuing. So we have markets like Paris up 50%, Madrid up 30%, London up 25% in ADR. And that really is where they're running on a lower occupancy. So it's not really the demand or the occupancy that are driving that rate, but it is certainly helping as that's filtering through this year. So an amazing year so far for the key gateway cities. Now, not all countries are equal. So although Europe has had a wonderful performance, that absolutely depends where you are. So here we're looking at RevPAR, indexed to 2019 at the end of the first quarter. And I'll show you why I've removed April. We'll come on to that. So we're just going to look at the first quarter. We can see Ireland up 34%, the UK up 18%, France up nearly 30%. So fabulous growth in RevPAR terms. But if you go to the middle of Europe and look at Germany there in the middle, and then generally the DACH region, Benelux, and then Central and Eastern Europe, below 2019 levels in many cases in RevPAR. And that is primarily occupancy, but rate as well. But really it's occupancy that is driving that poor performance in RevPAR terms. Why is that? Well, there is a more conservative domestic demand in these markets. So in the UK, France, Spain, all of these markets that are outperforming 2019, there is a really strong domestic demand, and that continues into 2023. Germany, as we all know, is really dependent on groups, particularly in the key gateway cities there, and that group recovery has not come back yet, although it is starting to come back, and some positivity there. They also do not benefit from the dollarized traveler. They don't have that luxury traveler, long-haul international traveler coming into their markets as much as the other key gateway cities. So that also has been difficult for those markets. So a very, very different picture, and to show you how the markets like Italy have generated 32% growth in the summer months indexed to 2019 and ultimately growing double-digit throughout. So a really stellar performance from Europe, but some key markets have had a more difficult Q1. But if you look at the next slide, you'll see that the tide is turning for all of these countries. So this slide, admittedly, is not great, but if you look at the dotted line in the middle, that is the average. So the average occupancy indexed to 2019 is just 6% off 2019 levels. The green line at the top is 100, so have achieved it. So you'll see that there are a number of countries that have outperformed 2019 as they've gone into April. So Italy, Germany, Ireland, Portugal, the UK, all these countries performed well at the back end of 2022, and that continues into 2023. Then the other countries that were in the middle there that were underperforming in RevPAR terms up until the end of Q1 actually globally have just started to outperform the average, certainly, and are just about to tip 2019 levels. So you're looking at markets like the Netherlands and Germany about 3 percentage points off 2019 levels in the months of April and May. So really there has been a big shift. And I really think that that is reflective of what we saw last year for the rest of Europe. It was April, the tide turned for every country in Europe with the exception of this DACH region, and now it's happening 1 year later. So a really, really interesting journey for these markets as we move into the rest of the year. Again, in Europe, no different to the global picture that I showed you, but they really do mirror the national trends. So you can see key cities like London, Paris, Brussels, London, Paris, Amsterdam, etc., all growing year on year in occupancy terms. But again, in that DACH region where you see the yellow bubbles, they're still below that 90% mark. So it's still not bad, but it could certainly be better. And in RevPAR terms, so that occupancy and that ADR combination is returning double-digit growth for most key cities. There are a few exceptions there, Vienna, Zurich, and Prague, but the majority are in single and double-digit growth in RevPAR terms. So all looking good for the key gateway cities in Europe. And if we just summarize that in the journey from January 2022, Omicron times, you can see occupancies were down by 40%, then 30, then 20 as the quarter went on. And then it's just kind of simmered along anywhere between 5 and 6% below 2019 levels as we lead up to May. But the stellar picture here is that ADR that has continued, despite occupancy being low, has continued to grow and maintain month on month. And as we go into April, and surprisingly May, we have seen further growth in ADR. So the average RevPAR index for Europe is up 13% year on year. Sorry, not year on year, versus 2019. That would be nice if it was year on year. So nominally, RevPAR up by 13%. If you strip out inflation, so that real indexed piece is we're just below 2019 levels, so 3% below. So it is great at the top, on the top line, but certainly more difficult on the bottom line. So we're not quite there yet, but getting closer and closer. And by the end of June and July, I would imagine that we will be indexing above 2019 levels on a more stable basis. If we look at the GOPAR, the GOP per available room, again, up 10% on 2019, but strip out that cost of doing business and inflation, and we're just 6 percentage points off 2019. So it's slowly filtering through to the bottom line. So we are in an economic crisis. It depends what day you read the papers, but for the hotel industry, it does not look like that. If we look at demand, as I showed you at the beginning, demand is certainly here to stay. So in Q1 2023, all of the European cities in aggregate, plus the APAC cities, reached 2019 levels in terms of demand. As you can see, the UAE has always been there. So a very, very strong picture. All the vital signs are looking good, and there are more opportunities coming. So we've kind of done all the, the load factor in the airlines, as I mentioned, the visa restrictions, the COVID restrictions have been removed. But now there is more business coming. So let's dive into that a little bit. So inbound travel to Europe is expected to grow year on year and into 2024, and is actually expected to achieve 2019 levels by 2025. So markets like London will see a 16% lift in international arrivals year on year. Paris is expected to top the charts as the US being its source market. So US source market for Paris in 2019, it was 11% of total accommodation nights. This year, it's expected to reach 17%. So you can see the power of that long-haul travel coming through. The top 10 European cities compared to 2019 have not really changed. London is at the top. Madrid is at the bottom, still not bad, at number 10. But what is interesting is Vienna was sitting in 9th place, and it is being replaced by, can anyone guess? A city in Southern Europe, a market in Southern Europe that has done extremely well with group business, transient, leisure, corporate, and that is Lisbon. So that has actually entered the top 10, ninth place, pushing Vienna off that top 10. So an interesting, and that data is from Tourism Economics, actually. Another huge piece of the puzzle that we have been missing in Europe, well, across the globe really, is of course China. So here's a view on China outbound overnight since the year 2000, right up to 2025. So you can see that since 2020, I mean, there has been pretty much no inbound travel no outbound travel from China. But 2023 is expected to recover by the end of the year at about 69% of 2019 levels. And then that will further grow into 2025 for a full recovery of China outbound. So that 70% sounds amazing, sounds like it'll fill all the voids that we have in Europe, but it will not, because it was going to take a long time for that travel to come out of mainland China, to come out of the Asia-Pacific region, and then over to Europe. But slowly, slowly, those visas are being printed and issued, and the Chinese traveler is coming back. So that's a huge opportunity for the hotels in Europe. Another huge opportunity, as I mentioned a few times, of course, are the Americans, balancing the books. I mean, all of those ADRs that we're seeing in markets like Rome, Milan, Paris, etc., a lot of that is being generated by the American traveler. So like I said, in the DACH region, you don't have the American traveler willing and able to pay those rates. But in markets, so this is 2019 data. I do wish I had this for 2023. I'm going to try to get it. But it shows the power of the American travel in key gateway cities and what we have all been missing. So markets like Dublin, 14% of their paid accommodation nights were paid by the American traveler. Paris, as I mentioned before, 11%, and that expected to grow to 17%. So a really important part of the business. Another huge part, of course, is corporate. So we've all been waiting for corporate to come back. Domestic corporate came back, of course, through 2021 and 2022. International corporate started to come back in 2022, but looking at midweek nights, it didn't look very, very exciting. And although I've chosen kind of an odd period, because it brings us up to current day pretty much, because we have Easter on one side, and then we have May and all of the bank holidays we had on the other side. But where you see positive growth, they were the only 2 business weeks that were essentially available to the market between Easter and May. And they were positive. So I think that has a good story. And weekend nights, of course, doing as well as ever. But I really think that shows that there is definitely more to come in June, and July from a corporate perspective. And those midweek nights are evening out. We don't have those peaks and troughs that we were seeing previously. And groups, of course, is going to follow suit. So group demand, again, down 40%. I think last year when I presented, it was probably more like 60 and 70% in Europe. But we're looking at an average of 40% decline year on year. And you have to remember that we're looking at Easter versus a different Easter period in 2019. However, what I think is really interesting is, again, those 2 weeks in April, those second and third weeks in April after Easter, there's actually only a 10% decline in groups. So I think that is quite telling of what is to come. And of course, transient demand continues to outperform and compensate for that lack of groups. I mean, in the market, semantically, definitely, it looks like 2024 will be a bumper year for groups. But 2023, I think, in the second half, there is opportunity to grow. So with all of that additional demand, we are continuing to see those recession-busting rates. So what I'm showing you here is from 7th of May 2022 up to the 20th of May 2023. All those bars are above the line. The light blue is bringing you up to the nominal ADR index, so that's actually what was achieved by the hotels. And then the dark blue is where we strip out inflation. So you can see that in January, February, March, when you stripped out inflation, we weren't quite achieving 2019 levels, so the hotels weren't really making as much money as they may have liked, despite the heightened ADR. But as we go into April and May, every week, these are actually 2 weekly bars, you will see that they are outperforming 2019 levels, both nominally and in real terms. So a really positive picture, and that ADR, although STR has forecasted for it to be quite moderate year on year in terms of growth, it does continue to grow. It's certainly not going back, despite the business mix changing. And rate growth was a luxury story. So occupancy was always an economy and mid-scale story. Luxury rate growth was always a luxury story. But these rate premiums are now being accepted in all categories. So this is running up 12 months up till April, so running 12. And since April 2022, that demand and pricing power has trickled back to all hotel classes. Occupancy levels are certainly still lighter for luxury class, but we're still looking at a 26% lift in RevPAR terms, and compare that to economy, a 21% lift in RevPAR terms for economy hotels. So really, those key gateway cities, luxury hotels, are reaping the benefits of the international business, of the corporate group mix, the heightened leisure demand, and the economy hotels are not being left aside, because in those secondary and tertiary markets where these hotels are more present, there still is a lot of demand for staycation, for corporate, transient, domestic, etc. So really, it is the message I'm trying to get across here is that every hotel class is benefiting from the demand. Every market is also benefiting from the demand. So if we go a little bit now into the future and what to expect, considering how well it is looking so far, going forward, it is looking pretty good too. So business on the books is looking very, very strong. So you can see some single-digit business on the books for most key markets in Europe, and that's versus same time last year. So a market like Dublin has 4% more rooms sold than it had for same time last year for the next 90 days. So it's looking pretty strong. All those that are in green, we estimate will outperform 2019 levels in terms of occupancy over the next 90 days. All those that are in orange will sit anywhere between 95 and 100%, so based on historic performance. So a very, very strong and good picture for the key gateway cities. Resorts. So there's a lot of question marks about staycations and resorts for 2023. So if we look at the dark line here is the staycation markets, and the lighter mauve line is the resort market. So you can see 2022 resorts outperformed staycation markets. Again, April came, no more COVID restrictions. Everyone decided, I'm going to travel. I'm going to get on a plane. I'm going to go abroad. I am sick of going to Cornwall or to any staycation market. And that has continued into 2022. And you can see that resorts outperform staycations and even into 2023. Now, if we look forward, again, there's going to be a lot of concern about how these staycation markets are going to do considering the ease of travel, but it's looking pretty positive. Resorts, however, are looking more positive. So an area like Lake Como, it's got 6% more on the books for the next 90 days. Italian Islands, 11% more on the books for the next 90 days. Staycation looks quite stable. So Cornwall and Devon, 1%, Lake Geneva, 3% up year on year. So although it may not be a bumper year for staycation, the hotels will likely be full, certainly on those key nights. So resorts are set to outperform 2022, and staycation is still on the cards for many. Despite that, so we've got the key gateway cities attracting business, we've got the resorts attracting business, but the regional markets are not losing pace. They are still attracting business. And as I mentioned before, that is a combination of staycation, leisure, but also corporate, domestic corporate demand. So if we look at some key countries here, you can see the RevPAR performance for secondary and regional markets for all of these countries, with the exception of Germany, are all in green, so all positive. And then if we look forward for the next 90 days, all of these markets have more business on the books than they had same time last year. Italy and Portugal have double-digit more, so are looking very, very positive for the next 90 days and the summer as a whole. So a really strong picture. So like I said before, it's not just all classes. Now we're talking all markets are also looking forward to a positive result. So I'm just going to dive into a few countries. We just developed these slides in the last few weeks to try to give everyone a better view at a country level. So I hope you like these, and if you do, we will do more of these in the future. So for those of you interested in the UK, we're looking on the right-hand side. The chart is showing you a summary of where this market is, or where this country is at the end of April 2023. So RevPAR in the UK up 21%, and that's all generated by ADR. And then if we look on the map, what we're saying here is that same time last year, we have more business on the books in most markets in the UK. So a very positive outlook. And then, of course, there are some markets that are declining, but the majority of markets are up on last year, particularly the international markets like London and Edinburgh. Let's go to the summer markets, to Spain. So very similar, up 21% in RevPAR terms. And if we look to business on the books in those key markets, all looking at growth year on year. And I mentioned Portugal, and this is shaded out here because we're focusing on Spain, but Portugal, you can just about see that there is good growth as well, double-digit growth versus same time last year in terms of business on the books. So a really strong summer ahead for Spain, for sure. And Italy, I mean, it's just astounding how this market is performing. Again, up 31% in RevPAR, so outperforming France, outperforming the UK in RevPAR terms, growth. And then if we're looking forward, we're looking at double-digit growth for markets like Rome, Florence, Milan. So a really positive summer, again, looking forward for these markets. And then not to put a dampener on it all, but Germany has had a very different experience, like I said earlier. So down 6% in RevPAR terms. Despite that, despite the occupancy declines, ADR has grown. But what is important here is that these markets are starting to see some light. They're starting to see some growth versus same time last year. So again, business on the books for a market like Munich is up 3%, same time last year. Frankfurt up 3%. So we've got some positive numbers coming through for these markets. So all RevPAR, all markets, with the exception of a few in Germany and a few in China, which is no surprise, will recover fully in RevPAR terms by the end of 2023. Some of those recovered already at the end of 2022, but it's looking like the growth continues. So we're looking at Paris up 50%, more than 50% in RevPAR terms, noting that this is luxury and upper upscale only. And then we're going down to 40, 30, 20. But even the Zurich, right at the end, we're looking at a 5 to 6% growth in RevPAR terms versus 2019. So some amazing performances expected for the rest of the year for these key cities. All of this is through ADR, of course, as we know, so we're going to have to continue focusing on that ADR piece of the pie. As you can see, occupancy, it continues to trickle through, but it's not going to quite reach 2019 levels by 1 year from now, so mid-2024. It's going to take more time than that because of the supply coming through. So demand is still very strong. It's delivering that occupancy, but it's really ADR that's delivering that RevPAR. But as you can see, we've got kind of a flat line running through 2023 and 2024 with, some growth. But the important message here is that growth achieved in 2022, and we're talking, 30, 40, 50% growth in ADR, is not going away. It's definitely going to stay with the hotels. And will they be able to grow more? Some markets certainly will. Some markets won't. It really depends on the consumer's appetite to pay those rates. And in the long term, it looks phenomenal as demand continues to grow year on year. Occupancy grows with that, and by 2027, we'll be back up to 2019 levels, considering all of the new supply that will come through. And ADR continues to grow ever so slightly, more normalized, more like a 3 to 5% growth every year. So a very, very strong outlook for Europe as we look forward to 2027. So in summary, supply growth is benign, and that is helping. So, there were closures during COVID, but that has been offset by any new openings. There is a future supply growth of about 1% per annum, so not huge, but still can be significant in some markets. Recessionary risks should be offset by the tailwinds from the recovering business demand, like I showed you, the group demand, the resilient leisure travel, and all of that new China and US long-haul business that's coming through. And definitely, as you saw on the slide, for the majority of markets, occupancy on the books is much stronger than same time last year. Rate growth, you'll all be happy to hear, remains real, but gateway cities will probably lead that growth in 2023. Resorts are going to have another record year, and rest of the market, as I showed you earlier, economy, mid-scale, upper mid-scale, is closing the gap on luxury, and it looks like that will align and normalize as we go through 2023 in terms of growth. So that is it from me. Thank you so much for your attention. And I'll be here for a while more if you have any questions. Thank you.